We have gathered a panel to examine recently enacted federal disclosure regimes affecting real estate investments and finance. Our panel today includes Kris Ferranti and John Beahn, partners at Sherman and Sterling.
The CTA essentially culminates a multi-year effort to prescribe more robust disclosure. The CTA very much remains a work in progress, since many of its significant provisions are yet defined, and specifics will only be known when regulations are issued, which are due within 1 year from the CTA's enactment. Critical questions as to its reach and scope remain unanswered. Importantly, the CTA will not be effective until these regulations are issued. So what is the CTA exactly? The CTA will require certain entities called reporting companies to provide detailed information about their beneficial ownership to the Financial Crimes Enforcement Network, or FinCEN. FinCEN is a bureau of the U.S. Treasury Department. The CTA defines a reporting company as any corporation, limited liability company, or similar entity that is created by filing a document with the Secretary of State in any state, or formed under the laws of a foreign country and registered to do business in the U.S. There are at least 20 classes of entities exempted from reporting because they were deemed either sufficiently regulated or just considered low risk. Examples of these exempted entities include publicly traded companies, certain investment companies, brokers or dealers, pooled investment vehicles operated by certain exempt entities. If an entity is considered a reporting company, then it must report the name and specified personal information of any beneficial owners to FinCEN. And beneficial owners for this purpose is a defined term. The CTA defines beneficial owner as an individual who, with respect to an entity, directly or indirectly by contract, relationship, arrangement, understanding, or otherwise, exercises substantial control over the entity, or owns or controls not less than 25% of the ownership interests of that entity. The CTA doesn't define substantial control, but instructs FinCEN to provide clarification through the regulations. Complex capital stacks and differences in decision-making, governance, and operating agreements may make determination of ownership and control much more complicated and difficult. We're hoping the regulations will provide more details. Who has access to the reporting? The CTA creates a beneficial ownership registry for disclosures, which FinCEN is tasked to administer. FinCEN is required to maintain disclosures for at least 5 years after the reporting company terminates. Importantly, disclosures may not be shared with the general public. Disclosures also cannot be requested under the Freedom of Information Act. FinCEN may, however, share the information with federal agencies and federal, state, local, and tribal law enforcement agencies for law enforcement purposes, including tax administration. FinCEN may also share the information with financial institutions for due diligence purposes with customer consent for use in their KYC and AML compliance activities. And no doubt we'll likely see some financial institutions request or insist on borrowers' consent, maybe pre-approval for purposes of accessing that information from FinCEN. Reporting will likely commence in January of 2022 at the latest. Once the Treasury publishes the regulations, new entities will have to file their disclosure reports with the Treasury Department upon formation by filing a beneficial ownership statement. Once the Treasury publishes the regs, existing entities will have up to 2 years to file their disclosure reports with the Treasury Department. Reporting companies must also file an updated statement of a change to any previously reported information within at least 1 year after the change. Penalties for willfully violating the CTA include fines up to $10,000 and up to 2 years in prison. Given the prevalent use of LLCs in organizational structures for real estate, if you're involved in real estate transactions, you can expect having to regularly assess CTA reporting requirements. The CTA's exemptions do not seem to cut it for real estate investment. So, for example, the exemption that for entities that have more than 20 full-time employees reporting more than 5 million in annual revenue and operating out of an office physically located in the U.S., the exemption generally will not apply to real estate structures. This is because most real estate entities that own real estate do not hire their own employees. They typically engage an affiliate or an outside property manager that employs the property management personnel.
CFIUS, as it says on the slide, is a committee of federal agencies that have separate but overlapping national security prerogatives. The Treasury Department is the chair of CFIUS, but as you see there, many other member agencies feed into the CFIUS process, and 3 agencies in particular really do drive and lead transaction reviews, and those are the Departments of Justice, Defense, and Homeland Security. Now, CFIUS, when they look at a transaction, CFIUS will typically conduct what we call a national security review of a transaction, and that really takes a look at 3 major issues. Number 1 is the profile of the party, the buyer, the foreign party that's making the acquisition or the investment. Secondly, CFIUS will look at the U.S. business. They will want to understand the sensitivity of the U.S. business and the assets that are being acquired. Third thing CFIUS tends to look at is what is the harm that could result if the foreign buyer had nefarious motives. What harm could result from the transaction? So it's really a balancing test that CFIUS undertakes in connection with its review, taking into account each of those factors. What exactly is FIRRMA? FIRRMA was 2018 reform legislation that really expanded CFIUS's jurisdiction and updated its scope. There was a sense in Congress and throughout Washington and among many policymakers that CFIUS and the transactions that CFIUS was reviewing, that it didn't have all of the capabilities and the regulations it needed to conduct very thorough and efficient national security reviews of those deals. FIRRMA made a number of important changes to the CFIUS process, number 1 of which is that FIRRMA expanded CFIUS such that it is no longer a voluntary process. For many years, CFIUS was a discretionary filing that parties could decide to make it. And importantly for this audience, certain acquisitions of real estate now are subject to CFIUS review. As we'll get into in a little bit, CFIUS's regulations historically only covered the acquisition of a U.S. business. However, due to certain acquisitions of standalone real estate, real property, other real estate assets such as buildings without employees or operations that created national security concerns, Congress wanted to ensure that CFIUS's authority and jurisdiction to review those transactions was expanded. So now CFIUS does have the ability and the authority to review standalone acquisitions of U.S. real estate. Now, FIRRMA specifically grants CFIUS in these areas with authority to review transactions that result in the purchase or lease by or concession to what is known as covered real estate under the regulations. Importantly, any of these transactions that are subject to CFIUS jurisdiction are not subject to mandatory CFIUS filing. So if you're involved in a transaction that has a foreign entity acquiring an interest or acquiring ownership of U.S. real estate, you are not subject to a mandatory filing. It is only still a voluntary filing requirement. So you have the discretion to decide whether to subject that and whether to make the filing with CFIUS for that transaction. The regulations specifically define each of those terms. Kris knows these terms very well. He and I have worked on a number of matters where we looked at these very closely. Now, what is covered real estate? As I said earlier, only transactions, purchases, or leases of covered real estate are subject to CFIUS jurisdiction. And the regulations define covered real estate as land, including areas, subsurface areas, buildings, or structures. But each of those, either the land or the building or the structure, has to be proximate to a designated U.S. government and military facility. This is very important. Not all real estate in the United States or foreign acquisitions of real estate interests in the United States are subject to CFIUS jurisdiction. It is only acquisitions of real estate that are proximate to designated U.S. government and military facilities and installations. And those facilities are identified in the CFIUS regulations. A foreign entity or foreign person must acquire at least 3 of 4 specified property rights in the covered real estate for the transaction to be subject to CFIUS jurisdiction. First is the right to physically access the covered real estate. The second is the right to exclude others from physically accessing the covered real estate. The third is the right to improve or develop the covered real estate. And last is the right to attach fixed or removable structures or objects to the covered real estate. Now, there are differences, as I said at the top, between what is covered real estate versus what is a U.S. business. Oftentimes, in the transactions that Kris and I have looked at, a key consideration of determining whether a transaction is subject to CFIUS jurisdiction is whether it involves the acquisition of a standalone, whether it involves the acquisition of a U.S. business, or whether it is truly the acquisition of a standalone real estate interest or real estate property. Now, happily, there are exemptions for certain real estate, which would carve a potential transaction out of CFIUS jurisdiction, and the regulations define certain categories of real estate transactions that are excluded from CFIUS jurisdiction. Now, this would mean that even if the transaction met all of the triggers for CFIUS jurisdiction, it would be exempt effectively from CFIUS jurisdiction. And the first and probably the most important, and the one we see most frequently, are acquisitions of real estate within an urbanized area or an urban cluster. The second type of transaction that is exempt from CFIUS jurisdiction is the acquisition of a single housing unit. Thirdly, acquisitions of real estate within airports and maritime ports is generally exempt from CFIUS jurisdiction if they're leases. And then lastly, certain transactions involving leases of commercial space in multi-tenant properties and multi-tenant buildings, wherever located, are generally exempt from CFIUS jurisdiction. And then lastly, there's another broad set of exemptions in the regulations which apply only to entities that are from what are called accepted real estate foreign states. The FIRRMA legislation created carve-outs effectively from the expanded CFIUS jurisdiction and CFIUS scope for entities that are from closely allied U.S. countries. And in the regulations that the Treasury Department adopted about a year ago, they initially designated the countries of Australia, Canada, and the United Kingdom